The Fed is screwed, and pardon my language in the title, but we just got news about how much they added to their balance sheet for the last week. We got news on what they have to do in the banking system right now, and we have to go through it. If you don't mind hitting the subscribe button underneath the video and turning on that bell notification so you know right when I post future videos, I think that will really help out the channel and will help you get some of the most up-to-date information possible, because I'm making this an hour after it came out because I just saw it, and the fact is I don't want to make you wait until tomorrow's video. Now, I talked earlier today in a video about what the government's trying to do, trying to take your crypto and your rights basically away from you. So watch that video. I'll put it on the end screen, but let's get into it. Bitcoin is right around 28,300. So it's looking pretty good here today. And the overall market was up as well, with the NASDAQ finishing about 1% up for the day. And a lot of that's due to the fact that people just don't think that there's going to be another rate increase. The Fed has said that they pretty much are expecting between 1 and 2 more 25 basis point hikes, but the Fed rate monitoring tool, or basically investors in general, are saying there's a 63% chance that they don't even get to raise one more 25 basis point hike. Now, why is that? Well, there are a couple different reasons. First of all, they continue to reduce, they said that they're going to continue to reduce the balance sheet as planned, and instead they're adding another $93 billion of liquidity this week. So now they're at $400 billion increase in 2 weeks. You can see it was about 297, then 93. This is the largest increase that we've seen since April 2020 over a 2-week period. Just basically cutting down the quantitative easing that they've been working, or cutting down the quantitative tightening that they've been working so hard at for a year, basically just swallowing up 2/3 of the progress that they made in a couple of weeks. Now, where is this all coming from? Well, a good portion of it is coming from the Fed Bank Term Funding loans. It rose from $12 billion to $53.7 billion. Now, what is this? It's exactly what it sounds like. This is what they created very recently to basically help out some of the banks. This is an emergency lending program created by the Federal Reserve just a couple weeks ago to provide emergency liquidity to U.S. depository institutions. It was established in response to SVB and Signature Bank. The program was created to support depositors such as American businesses and households by making additional funding available for eligible institutions to help ensure that banks have the ability to meet the needs of their depositors. So they added $53.7 billion just this week. Why are they doing this? Why would they add so much money to their balance sheet? It's because of the fact that the banks are having a very rough time. They're not able to continue to go through these rate hikes. It's basically breaking the banks because a lot of them held treasuries, and what the Fed is doing now is basically buying those treasuries back and buying mortgage-backed securities and taking them at face value. So they're losing, in a way, they're kind of losing money on this deal. They're helping out these institutions, thereby easing in the short term. Now, they're saying that they're going to take this off the balance sheet in the future, that this is only temporary, but I think that this still has a lot of easing effects, obviously. They can't continue to raise rates without providing this additional funding to banks, and I think they're going to have to U-turn. I think they're going to have to start cutting off the raises or start holding here soon. We'll talk about what that means, and then they'll have to eventually start lowering them. Now, the market is pricing in cuts by the end of the year. Actually, before the end of the year, they're expecting a lot of cuts. The Fed says that they don't see cuts in the future, but keep in mind, and I should clarify, they don't see cuts in the future for this year. They've said that they basically think they're going to have to cut next year, but not this year. Keep in mind, though, they have this Fed debt maturing this year. $6.5 trillion is going to hit maturity this year, and they're going to have to pay much higher rates because they still need this money. So what they're going to do is they're going to go and issue new bonds that are at much higher yields, or treasuries are at much higher yields. They're going to have to increase the amount of debt that they have to pay annually by a substantial amount. And every time that they don't lower rates, they're going to go more and more in debt. Now, it's kind of fugazi. It doesn't matter because the fact is the government is so in debt that, a couple extra $100 billion what's a couple $100 billion between friends, right? But they still have to err on the side of caution. They still are seeing problems here. They're still seeing banks having issues. Now, of course, they don't want to have runaway inflation. They want to make sure that inflation continues to come down. Jerome Powell's actually done, I think, a pretty good job of making sure that we know that's what they're trying to do. They will continue to raise rates even when things break because they are first and foremost trying to get that inflation down. However, there's only so far that they can take this. And if inflation continues to come down, which I'm seeing signs of it, even outside of the numbers, I think it's pretty obvious that people are cutting back and are being more cautious with what they're spending. I think that as soon as they see substantial progress, they'll stop cutting, they'll stop rate hikes. Basically, the next time that we see a good CPI print, I think they just hold. That's just my opinion. I could be wrong. Maybe they do 25 basis points more, but I think if we see them having to continue to add $100 billion to their balance sheet, and we continue to see banks going through these tough times. I mean, some banks were still down 5, 10, 15% here today in the stock market. And if we see inflation come down another couple prints, if we see like 5% inflation and it's substantially coming down, I think they're going to hold. And that will be really good for risk assets. It's going to be really good for crypto specifically, because crypto does really well when there's extra liquidity in the system. That's when we've seen massive run-ups in crypto, and it happens to coexist or coincide with the Bitcoin halving and some other things in crypto, the cycles. But typically that's very good for Bitcoin specifically and other cryptos as well. We'll have to keep an eye on it every week and see how much more they add. Do you think the banks are safe? Do you think the banks are going to continue to need this amount of liquidity? Do you think they're going to try to take advantage of this in some way or another? Because I think that this amount of money flowing into the system, someone's going to try to take advantage of it. And as crypto investors, as people that invest in growth companies, as they continue to provide more liquidity in the system, I think it will help out our stocks and equities and cryptos. This is going to be fascinating to watch over the coming couple weeks. I hope you all have a good rest of your day. I will see you tomorrow in tomorrow's video. Of course, if you want to get more information, check out the Patreon where I give buys and sells, exactly when I buy and sell different cryptocurrencies and stocks. It's mostly buying. And there are other links as well in case you want some free stocks underneath the video on M1 Finance, Moomoo, or Webull. Thanks, and I'll see you in the next.